IFRS 1 establishes the comprehensive framework an entity must apply when preparing its first set of financial statements under IFRS standards. The objective is to ensure that the first IFRS financial statements contain high-quality, transparent information that is comparable across periods and consistent with the guidance applied by entities already reporting under IFRS. IFRS 1 requires a complete transition from previous GAAP to IFRS, meaning entities must apply IFRS recognition, measurement, and presentation principles as if they had always applied IFRS, except where specific exemptions or mandatory exceptions apply. The standard emphasizes transparency by requiring full retrospective application of IFRS unless doing so would be impracticable or unless IFRS 1 permits simplified treatment. This approach enhances comparability across reporting periods while providing users with a clear understanding of how transition affected reported balances. The standard also ensures that the first IFRS statements provide a suitable starting point for subsequent reporting, promoting consistency and reliability in future years. IFRS 1 is not merely a conversion exercise, it creates a disciplined structure for entities to align their accounting policies with IFRS standards and communicate the financial impact of the transition clearly and faithfully to stakeholders. A key foundational concept in IFRS 1 is the date of transition to IFRS, defined as the beginning of the earliest comparative period presented in the first IFRS financial statements. For example, if an entity presents its first IFRS statements for the year ending December 31st X1, the comparative information for the year ending December 31st X0 must also be prepared in accordance with IFRS. Therefore, the transition date is January 1st X0. At this transition date, the entity prepares an opening IFRS statement of financial position, applying IFRS standards retrospectively to all applicable items. This opening balance sheet serves as the anchor for all subsequent IFRS reporting and must reflect IFRS compliant measurement for assets, liabilities, and equity as at that specific date. IFRS 1's retrospective approach ensures comparability and integrity across periods, but the standard recognizes the complexity involved. To ease the transition, IFRS 1 permits several exemptions, such as those for business combinations, cumulative translation differences, and share-based payments, while prohibiting retrospective application in circumstances where doing so would require hindsight. These structured rules allow entities to adopt IFRS faithfully while avoiding undue burden or distortion of information created by recreating transactions long after they occurred. IFRS 1 requires entities to make extensive disclosures to help users understand the effect of transitioning to IFRS. These disclosures include reconciliations between previous GAAP and IFRS for both equity and profit or loss. They must explain how the transition affected the entity's financial performance, financial position, and cash flows. The purpose of these reconciliations is to allow users to track the adjustments arising from applying IFRS instead of previous accounting frameworks. The transparency requirement is crucial because different jurisdictions often have materially different recognition and measurement rules, potentially leading to significant changes in reported results. IFRS 1 also mandates disclosure of the accounting policies adopted under IFRS and explanations of any exemptions applied. These disclosures help users confirm that the transition was conducted consistently with IFRS requirements and provide insight into management's judgment during the transition. The reconciliation process reinforces accountability, ensuring entities cannot obscure the effects of transition and must clearly document how IFRS principles have reshaped their reported outcomes. By mandating detailed disclosures, IFRS 1 ensures that the transition enhances, rather than reduces, the usefulness and comparability of financial information. Another critical aspect of IFRS 1 is its emphasis on providing a clean slate under IFRS while maintaining faithful representation of economic events. The opening IFRS statement of financial position is prepared as though the entity had always applied IFRS, which means previous GAAP balances cannot simply be carried forward. Assets and liabilities must be recognized or derecognized in accordance with IFRS, and measurement attributes must be updated to reflect IFRS requirements, such as fair value, amortized cost, or present value as appropriate. IFRS 1 prohibits the use of hindsight when determining historical estimates, meaning management cannot revise estimates based solely on new information that became available after the original reporting date. This ensures that transition adjustments reflect genuine differences in accounting frameworks, not revised judgments or improved information. The standard thus balances practicality with conceptual rigor, providing optional exemptions where strict retrospective application would be unrealistic while preserving the integrity of the opening IFRS figures. The result is a robust, transparent starting point for IFRS reporting that supports consistency in future periods and enhances the comparability of financial statements across entities and jurisdictions. 2. Practical factors. Transitioning to IFRS involves a series of practical considerations that extend beyond technical accounting adjustments. Entities must recognize that adopting IFRS affects internal processes, staff training, data systems, and governance structures. Preparing the opening IFRS statement of financial position requires gathering historical information that may not have been tracked under previous GAAP. This often necessitates data reconstruction, valuation exercises, and revised documentation practices. Organizations must assess whether their existing accounting systems can support IFRS measurement bases, such as fair value measurements, component depreciation, or impairment testing, or whether system upgrades are required. Staff training becomes essential, as finance personnel must understand not only the mechanics but also the principles underlying IFRS. Communication with auditors, investors, and regulators is also a significant practical element. Stakeholders need clarity on how transition will affect reported results, key performance indicators, and compliance obligations. IFRS 1 therefore demands operational readiness alongside technical compliance, requiring coordinated planning across departments to ensure a smooth and reliable transition. Another practical factor is the need for entities to manage the transition timeline effectively. IFRS 1 requires full comparative information, meaning entities must start collecting IFRS-compliant data well before their first IFRS reporting date. This often means preparing dual reporting, under both previous GAAP and IFRS, for at least 1 year. Such dual processes increase workload and require meticulous data reconciliation. Entities must also decide whether to apply optional exemptions available under IFRS 1. These choices can significantly influence reported results and long-term accounting outcomes. For example, applying the business combinations exemption may simplify transition but could alter future goodwill balances. Entities must weigh the operational complexity against the benefits of simplification. Management must also consider communication strategies to ensure that users understand why certain exemptions were chosen. Transition planning thus becomes a multi-step, cross-functional project requiring project management discipline, clear timelines, and proactive coordination with auditors and governance committees. Cost considerations also play a major role in IFRS adoption. Transitioning to IFRS can be resource-intensive, requiring valuation specialists, external consultants, system reconfiguration, and extensive training. Entities must evaluate whether existing systems can handle IFRS-level disclosure requirements and whether automation or new financial reporting software is necessary. IFRS often requires more granular information than local GAAP, for example, segment reporting, fair value hierarchies, or detailed employee benefit disclosures, which may require new data collection processes. Smaller entities may experience greater strain because they often lack specialized IFRS expertise in-house. Budgeting for implementation costs therefore becomes a key practical factor, and management must consider whether the long-term benefits of enhanced transparency and global comparability justify the upfront investment. In many cases, entities find that IFRS adoption improves internal reporting quality and facilitates foreign investment, but only after navigating the short-term financial and operational burdens associated with the transition. Finally, practical factors extend to broader organizational implications, including governance, stakeholder relations, and strategic considerations. IFRS adoption may influence debt covenants, performance metrics, executive compensation, and regulatory compliance. Because IFRS measurement changes, such as fair value adjustments or revised impairment rules, can significantly affect reported profits and net assets, entities must communicate proactively with lenders, shareholders, and regulators to manage expectations. Boards and audit committees must oversee the transition, ensuring adequate controls, documentation, and risk management systems are in place. IFRS adoption can also improve comparability with international competitors, potentially enhancing access to global capital markets. For multinational groups, IFRS improves internal consistency across jurisdictions, simplifying consolidation and reducing differences in local accounting standards. However, this strategic benefit requires alignment of global policies, training across subsidiaries, and increased coordination among finance teams. Practical factors therefore encompass not only accounting changes but broader organizational transformation, requiring planning, resources, and robust governance to ensure a successful and credible transition to IFRS reporting.